This week we're looking at two key drivers. If we start off in the oil market, the main driver this week is going to be OPEC. As we approach the 30th, so Wednesday, we're due to have the OPEC biannual meeting. Now, in the weeks previous, we've seen a preliminary agreement between OPEC members to cut production going forward. At this meeting, we're looking at a bit more clarity. They've speculated over a lot of different rates and a lot of different countries cutting to different levels. But the outcome of this meeting should be, with some resounding clarity, what the production is going to look like for at least the next 6 months. And that should determine where oil price goes over the short term. At the moment, expectations are that they are going to agree a cut of some sort. And that's partly the reason we're seeing prices as high as they are in the oil market at the moment. However, historically there have been a lot of disagreements and members have walked out of negotiations before. If we see something like this happen again, there's potential for a sell-off in oil over the short term as no production cut is agreed and we potentially maintain the oversupply going forward. Now back to gas and power. In terms of fundamental drivers, the key one this week is going to be weather. We're experiencing the coldest November temperatures for many years this week, and that's potentially going to see demand increase over the short term, potentially putting a bit of a premium on the day ahead market as well as contracts close to delivery. So we look at day-ahead prices for both gas and power. At the start of this week we've seen them push higher, and that's a result of that colder weather we've already mentioned. As we progress through the week and temperatures get colder still, there's more potential for prices to increase. Those higher day-ahead prices are having a knock-on impact on contracts close to delivery, so kind of December, January, February, March contracts, they're all trading higher again after having quite strong losses earlier last week. Looking at seasonal prices, they've continued to consolidate. So we saw market highs back in the start of November, and then prices began to fall in line with crude oil price losses. However, over the last week or so, prices have started to consolidate and haven't fallen much further, and this is looking more like a dip in the overall uptrend than a market reversal. So as I mentioned, this isn't at the moment looking like a reversal in the trend, and prices are still trending higher. This recent dip in the market is more of a buying opportunity. So customers who haven't placed fixed price contracts should look to enter the market as soon as they can to capitalise on this recent discount in prices. And again, consider placing over kind of 2, 3, 4 year periods as prices are actually cheaper further away from delivery you go, specifically in the power market. In terms of flexible contracts, again, it's down to attitude to risk. Much of this winter is going to be potentially volatile. As we've mentioned, we're seeing cold temperatures and a lot of fundamental changes in both gas and power market, as well as in crude oil, all of which could lead to volatile price action. So if you err away from risk, you're probably better off taking a higher hedge throughout the remainder of winter, possibly into next summer. But as we've said, market prices are still trending higher, so if you're in a position where you want to mitigate further increases, then I would potentially looking at increasing the hedge across your contract duration to mitigate from rising prices over the short term.